Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Jay Gragnani, Head of Research and Client Engagement with Nasdaq Dorsey Wright, to discuss the first U.S.-listed Bitcoin ETF, interest rates and inflation, and, of course, market seasonality. Jay, it's great to see you again. Welcome back to Trade Talks.
Great to be here, Jill. Thanks for having me.
You got it. And we've seen it reflected in Bitcoin pricing as well as the other altcoins, certainly taking a cue from listing of the first U.S. Bitcoin ETF. What are your thoughts around that?
They have been. Well, I'll say it's been a long time coming. I know there's been a lot of back and forth with registration and the SEC. And this week reminds me a lot of when we saw the first commodity or crude oil-based ETF launch back in 2006. And it's monumental from the perspective of it opens up access and opportunity for investors that otherwise might not have opened up accounts and gone to access Bitcoin in different ways. It opens up access to many more investors to Bitcoin. And I think it's probably the first of many to come. Again, I say it reminds me of when USO launched back in 2006, which was the first crude oil ETF that provided exposure to crude oil through the use of futures contracts. And that's exactly what this Bitcoin product is doing, is providing exposure to Bitcoin through the use of futures contracts. And so that's important to understand. On the surface, it might not mean a whole lot, but is that there is some nuanced details in the fact that it's not owning pure Bitcoin, if you will, or spot Bitcoin prices. It is owning the futures contracts of that. So not right, wrong, or indifferent, just something as an investor, if you're considering something like the Bitcoin ETF, understanding how the futures contracts work, understanding the roll process of the futures contracts underneath that, and how that may be different than what you're seeing in the pure spot price of Bitcoin. Nonetheless, I think it is a major step forward for the entire cryptocurrency space, for the ETF industry at large, which continues to show that it is a very innovative space out there. And now seeing this come out, I would fully expect, at least the first one in the U.S. that is, I would fully expect to see more come on the heels of this, not only for Bitcoin, but for other coins and potentially other indexes that track a basket of different currencies. So, very, very monumental day here.
Yeah, it certainly is. And I'm really glad that you brought up that distinction about the underlying basket, because while it's in the ETF wrapper, you still have to worry about what's happening underneath the surface. And it could be close. Who knows this year if we get any closer to a spot, or perhaps the following year. There's a couple of them in Canada with a purpose. So the spot ETFs do exist. Let's talk about interest rates and inflation, with the 10-year moving back up above 1.6%. And of course, Jay, transitory inflation doesn't feel very transitory anymore.
Yeah, that was certainly the word that was thrown around a lot a few months ago. You're hearing less and less than that, as it seems that inflation certainly is not that transitory, or not as transitory as initially thought. I mean, you look around the board, you mentioned the 10-year yield moving back up above 1.6, closing in on where we were earlier in the year, back at 1.7. And, what you're seeing too is just the impact of, from an inflation perspective, an impact of the underlying raw materials and i.e. commodities are just continuing to move higher. Crude oil moving up above $83 a barrel. And, that is probably the biggest and most important commodity as it relates to the broader base commodity indexes out there. But really, it's up and down the board. You go up and down the board and you look at things like coffee, you look at things like cotton, you look at, all of these raw materials, copper inputs that go into a lot of goods that are consumed, a lot of manufacturing goods, and the prices are certainly moving. And I think individual investors, I think manufacturers, I think a lot of consumers of these goods are certainly feeling the effects of that. And you're seeing that show up as we're in the heart of earnings season. You're seeing that show up from guidance from companies that are having to raise prices of goods as a result of seeing the rising prices of those underlying commodities there. With that said, as it relates to inflation, when you think about how to hedge or how to protect against inflation as an investor, the commodity market historically has been a really good inflation hedge. It's been interesting, though, out of the strength that we've seen across commodities, precious metals has really been the one that has kind of been left behind. It's been the area, gold and silver, that have just lacked the performance there, or lacked the participation that we've seen from a lot of other commodities. So, commodities market typically provide a pretty good hedge. And then as it relates to the equities, when you think about interest rates and you think about inflation, historically, financials and energy are the two sectors that have the highest correlation to movements in the 10-year yield index. And in other words, those are the two that tend to move the strongest as rates are going higher. Financials and energy are historically those two sectors that have moved most closely with the rising interest rates. And, the financial sector specifically here recently moving to new highs on the heels of a lot of positive earnings last week out of a lot of big banks. So certainly you're seeing a rise in interest rates, you're seeing a rise of inflation, and it seems to be inflation is here to stay.
And November starts a seasonally strong 6-month stretch in the market. How are you positioning your indicators heading into that time?
Yeah, it does, and that's we're about to end the stretch of the year that is comes under the adage of sell in May and go away, and that is the idea that you sell the market in May and you buy back in at the beginning of November. And the reason for that is just historical bias. Historically, if you look back at the market going all the way back to 1896, for instance, using the Dow, if you were to simply buy and hold the Dow Jones Industrial Average compared to just owning the Dow from the beginning of November through the end of April and then being in cash for the next 6 months, your return has basically been identical by being invested for just half of the year. And so the fact that we've historically seen a lot and the vast majority of the market gains come in this 6 months coming up is certainly something that is on investors' minds as you get into November and December, which are among the best months of the year historically going back for the market. So as we're heading into November, when we look at our indicators, we step back and we tend to see a generally positive picture where U.S. equities is the strongest from an asset class perspective within our asset class rankings. Commodities is number two, I'll say, and pretty close to being number two. And then when we look back at just the broader trends and the absolute measures, the vast majority of equities, about 75% of the S&P 500 stocks, are still in positive trends today. So as we're heading into the last week and a half or so of October, close to November time period, we're doing so on an equity front that continues to show a strong technical picture.
All right, Jay, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.